Welcome back to the Deep Dive. You know, when you think of 1929, the image that probably springs to mind is, well, disaster, right? Black Thursday, the crash, the beginning of the Great Depression.
Right, it's sort of this monolithic event in our collective memory, but the actual history, when you dig into the sources we've pulled together, it's much more complex. It's really a human drama.
Absolutely. And the material we're drawing on today is pretty incredible. Thousands of hours of research behind it. We're talking private diaries, court records, even, amazingly, access to confidential Federal Reserve Bank of New York board minutes from that exact time.
Exactly. That lets us track the decisions, sometimes moment by moment, that really shaped that whole period.
So our mission today is to explore that core idea. How does confidence just disappear?
Yeah.
You know, that's a gradually, then suddenly. We want to look at the powerful figures whose choices, whose egos sometimes drove this. It was like H.G. Wells said, this desperate race between education and catastrophe.
Yeah, let's start with the atmosphere back then, the 1920s, the new era, they called it, the big economic shift. Americans basically stopped saving, borrowing became the norm.
Just keep rolling the debt over.
Pretty much. The idea was you could just roll it forward indefinitely, as long as everyone kept believing tomorrow would be even better. Faith was the fuel.
And this created a huge split in society, didn't it? This massive gap between the city folks doing well and people in rural areas who were really struggling.
Definitely. A widening gulf. Wall Street started to feel like this giant balloon just floating way above everybody else, pumping up these incredible fortunes.
And the amounts of money were just staggering.
Astronomical. Even when you adjust for inflation, you had fortunes over $100 million. That's like, what, nearly $2 billion today?
Wow.
And top executives were making the equivalent of maybe $56 million a year. It wasn't just wealth. It was almost a spectacle.
So how did the average person get drawn into this speculative frenzy, into the margin machine, right? And the man behind it, Charles Edwin Mitchell. Sunshine Charlie.
That's him, chairman and CEO of National City Bank. Mitchell saw himself almost as an evangelist for stocks. He wanted the average guy to feel comfortable, see stocks like any other product you could buy.
And crucially, his bank made it easy.
Very easy. They pushed credit for margin accounts aggressively. This meant investors could buy stock, putting down maybe just 10% of the price.
10% down, borrowing the other 90.
Exactly. Pure leverage. And that credit, it just poured fuel on the fire. Margin loans exploded from around $1 billion up to nearly $6 billion.
There's that great Groucho Marx story that kind of captures the absurdity. He's looking at the ticker tape, sees RCA stock at $535 a share. And it pays no dividend.
Yeah.
So he asks his broker, you know, a pretty basic financial question. Why is this so high?
And the broker just dismisses him, says something like, Wall Street isn't localized anymore. The possibilities are limitless.
Limitless possibilities. No need for dividends or, you know, actual value.
And Groucho apparently was so impressed by the certainty in the broker's voice, not the logic, that he started repeating that line to his friends. That tells you something about the mood. Value became almost irrelevant.
Okay, so that brings us to early 1929. The Federal Reserve starts getting nervous. This feels like a bubble.
They were definitely concerned. The Fed started issuing advisories, trying to discourage banks from lending money specifically for stock speculation. This is where things get really interesting. The credit war begins.
And complicating things. Mitchell himself is on the board of the New York Fed.
Right, which was controversial even when it happened. The previous governor, Strong, apparently thought Mitchell had an exceedingly active and well-developed ego. He kind of wanted him on the board partly to muzzle him, keep him contained.
Didn't work out that way, did it?
Not at all. Because when the Fed made its move against speculation in March 29, the market took a sharp dive. Mitchell watched what he called the carnage.
And decided the Fed wasn't going to fix it.
He decided he would fix it. He saw a leadership vacuum, basically. Instead of waiting for Washington, Mitchell does something stunning.
What did he do?
He publicly declares that his bank, National City, would step in. He announced, the National City Bank will furnish $25 million. Just like that, aggressively lending when the Fed wanted restraint.
Hold on. By using his bank's money like that, wasn't he directly fighting the Fed, undermining their control? Did people see the danger immediately?
Some reformers did, absolutely. But the immediate effect, it stopped the panic. The rumors of his moves spread like wildfire, the selling eased off, the market actually reversed.
And that key rate? Call money.
Right, call money. These were those super volatile short-term loans for margin buying, often due daily. The interest rate on them, the call rate, had shot up to 20%, which was causing huge stress.
Squeezing everyone.
Exactly.
Yeah.
Mitchell's $25 million injection flooded the market with cash, pushed that call rate back down to 15% almost instantly.
So he looked like a savior.
Overnight hero. People were comparing him to J.P. Morgan and his earlier rescues. But behind the scenes, the Federal Reserve Board in Washington was described as apoplectic.
Furious.
They saw it as Mitchell completely undermining their authority, all for the glory, the selfish prestige of his own bank.
And this really put him on a collision course with Senator Carter Glass, didn't it?
Yeah.
One of the architects of the Fed system itself.
Oh, yeah. Glass became a lifelong enemy. He later blamed the whole crash on Mitchellism, saying the country had been aghast for months at stock gambling. He saw Mitchell as enabling it.
So Mitchell's defiance basically keeps the party going, maybe even encourages more risk.
It absolutely restored that irrational confidence, which, ironically, paved the way for even sketchier stuff, like the stock pools. These were the insider games that really fleeced the public.
Okay, walk us through how a stock pool worked. You mentioned William Durant, the auto giant, was involved in these.
Yeah, Durant was a big player. Basically, a group of insiders would secretly buy up a lot of shares in a particular company. Then, often working with a specialist broker on the trading floor, they'd just trade those shares back and forth among themselves at slightly higher prices each time.
Creating fake activity.
Exactly. It's called painting the tape. It makes it look like there's huge interest and the stock price is naturally rising fast. Volume and price go up.
So it looks like a hot stock, a rocket ship.
And the public, the gullible public, as the sources put it, sees this, gets FOMO, fear of missing out, and jumps in buying at the inflated prices.
Then the pool dumps its shares.
Correct. Right at the peak, the pool unloads its entire holding onto the newcomers, making a massive profit and leaving the public holding the bag when the price inevitably collapses.
Any examples of how big these could get?
Oh, yeah. Michael Meehan ran a huge pool in RCA stock. They gathered about $12.6 million, manipulated the price, and walked away with nearly $5 million in profit in just over a week.
$5 million in profit in a week back then. Just, wow. The mania wasn't just financial, though. It seeped into the culture.
Deeply. Rationality seemed optional. You had figures like Evangeline Adams, an astrologer known as the stock market seer.
An astrologer? Seriously?
Seriously. Her clients supposedly included Charlie Chaplin, maybe even J.P. Morgan Sr., and the New York Times actually reviewed her stock market predictions. That's how far things had gone.
And it wasn't just mystics. Respected economists were saying crazy things, too.
Absolutely. Irving Fisher, a famous Yale economist, declared in September, 1929 September, that stock prices had reached a permanently high plateau.
Permanently high. Famous last words.
And Mitchell, Sunshine Charlie, he agreed. Even in October, as things were starting to wobble, he said the decline was just a healthy reaction, nothing alarming about it.
Nothing alarming. Until Black Thursday, October 24th. That's when the floor really fell out.
Yeah, frantic selling just wiped out $1 billion in paper value almost instantly. Brokers were desperately sending telegrams. Your margin is gone, sell out or send more money.
Panic, which led to that famous meeting at J.P. Morgan & Co.
Right. Around noon, Thomas Lamont, the Morgan partner, gathered the heads of the major banks, the Big Six, they were called. They agreed to pool their resources.
How much did they pledge?
They each pledged $40 million. The idea was to step in and buy stocks, to fill the air pockets, as Lamont put it, to show confidence.
And then came the big theatrical moment, Richard Whitney.
Richard Whitney, yeah. He was J.P. Morgan's floor broker, ironically, later convicted of embezzlement, but that's another story. Around 1:30 p.m., he walks very dramatically onto the stock exchange floor.
Made sure everyone saw him.
Oh, absolutely. And he conspicuously places a big order to buy U.S. steel, well above the current asking price.
Why U.S. steel?
It was the bellwether stock, the market leader. The price didn't even matter that much. It was pure performance art. The message was, look, the House of Morgan is buying. The bottom must be here. Calm down. Trying to manage psychology.
Did it work?
Temporarily, it put a tourniquet on the bleeding for the day. But the following week, that brought Black Tuesday. The real meltdown. Billions just evaporated.
And Mitchell. What was happening in National City?
He got news that his own bank, trying to support its stock, had bought $32 million worth of its own shares. He knew immediately it was a very dangerous situation. It put the bank itself at risk.
The consequences rippled outwards, hitting even the rich and famous.
Yeah, Winston Churchill was actually visiting the U.S. and had gotten caught up in the speculation, trading heavily on margin. He lost about $75,000 personally in the crash.
Ouch. And then there's the Empire State Building.
Ah, yes. John Raskob, the auto executive, he started building it before the crash as this huge symbol of American optimism, a monument to the future.
But by the time it opened,
In 1931, the mood had completely changed. It was less than 20% occupied. People started calling it the empty state building, a giant, lonely monument to overconfidence.
built on certainty, open to doubt. And Jesse Livermore, the legendary trader, he actually made a fortune during the crash, betting against the market.
He did. He timed it perfectly. But then he couldn't stop betting. He lost it all again in later trades. Died basically broke, over $360,000 in debt. Shows you can't mistake luck, even brilliant timing, for sustainable genius in the market.
Eventually, Washington had to step in. The reckoning came with the Pecora hearings in 1933.
Right. Ferdinand Pecora led this Senate investigation that finally put Wall Street practices under a microscope, and Mitchell became a prime target. He even faced trial for tax evasion.
And this involved those wash sales,
Right.
selling stock to his wife to create a paper loss for tax purposes.
Exactly. It was a loophole, technically legal at the time, that allowed wealthy people to basically pretend they'd lost money by shuffling assets between family members or related entities. Pecora hammered Mitchell on this in the hearings.
Made him look bad, certainly.
Definitely. Pecora forced Mitchell to admit publicly that he, Sunshine Charlie, had personally suffered the biggest individual loss in National City stock. It shattered his image.
But legally.
Legally, he was acquitted. The wash sales, however unethical they seemed, weren't actually illegal under the rules back then. The law hadn't caught up to the reality of these financial maneuvers.
And that gap between the ethics and the law is what finally led to real change.
That's what fueled the big one. The Glass-Steagall Act in 1933. It forced commercial banks, the ones holding regular people's deposits, to completely separate from investment banking, the securities trading side.
Driven by Senator Carter Glass, Mitchell's old foe.
Primarily, yes. Though the politics were complex, there was also rivalry between the Rockefellers and the Morgans involved, but Glass spearheaded it. And it's crucial to remember, as you pointed out earlier, the complexity of Glass himself.
Yeah, it's a tough piece of history. The man who gave us this foundational banking reform was also simultaneously a staunch segregationist fighting hard for Jim Crow laws.
It's a jarring contradiction. It forces you to see that major, necessary reforms don't always come from pure motives or perfect individuals. They often emerge from crisis, from political maneuvering, from flawed people operating in their own time. The reform itself was needed, regardless of the complicated nature of its champion.
So Mitchell walks, Glass-Steagall passes, the financial system is fundamentally altered. But let's circle back to where we started, confidence. The sources suggest 1929 wasn't like other panics with huge physical destruction or death tolls. In fact, the national suicide rate apparently went down.
That's right. But it triggered the longest economic depression in U.S. history. Why? Because it utterly destroyed trust. Credit, belief in the future, the very thing Mitchell tried to artificially sustain, it just vanished.
And that seems to be the enduring lesson here. Not that we can prevent booms and busts entirely, maybe.
Probably not, but that we have to remember how easily we forget, how fragile that certainty is. Maybe the best defense against that kind of irrational exuberance isn't just more rules or being cynical, but maybe a bit more humility.
Humility. That feels right. H.G. Wells called history a race between education and catastrophe. We've just walked through the details of 1929, the insider pearls, Mitchell's gamble, the blind certainty of supposed geniuses. So the question for you, listening now, is what level of certainty, what kind of genius in today's markets are you willing to trust? Especially knowing, as 1929 showed us, that the greater the heights of our certainty, the longer and harder we fall. Something to think about.